थोड़ा सा और। Good morning and welcome, friend. Before we start the meeting, I request everyone to please rise for the institute motto and followed by national anthem. शुभमामी जागे शुभाशिष मांगे हरे मुबारक भाग्य विधान जय हे जय हे जय हे भारत माता की जय। Welcome again, friends. It gives me immense pleasure to welcome you all to today's seminar organized by our study circle. As we all know, the world of taxation, especially international taxation, is evolving rapidly with new amendments, judicial pronouncement, and compliance requirements emerging almost every month. Staying updated is not just important, it's essential for us as a professional. Friends, today's topic recent important amendments in the field of international taxation is both timely and highly relevant. And to guide us through this complex and dynamic subject, we are truly privileged to have with us one of the most respected names in the field of taxation, CA Hegde, sir. Friends, actually, sir, hardly needs an introduction, but for a brief introduction, I request our past convener, CA Purvi Bhageria, to come and give introduction. और इनके लिए सिर्फ जाते जाते मैं ये दो लाइन बोलना चाहूंगा कि शब्दों में जादू, अनुभव में गहराई, हर बात में छलके सादगी और सच्चाई, ऐसे ही हमारे आज के महान वक्ता जो हर दिल में छोड़ते हैं ज्ञान की निशान। प्लीज कम गुरु जी।
Good morning, all. It gives me immense pleasure to take the formal introduction of our today's faculty, CA Hegde sir. He is a well-known name in the field of direct taxation, and he's been a regular speaker at our forum, so doesn't really require introduction. Even he himself has given a two-line introduction for us to speak here. He is a partner with Deloitte and has been the Central Council member of ICAI from 2013 to 2019. Today, he will be guiding us through the field of indirect taxation, recent judgments and amendments. I request you all to kindly welcome him with a huge round of applause. Before we take to the podium, I would like to invite CA ML Kumawat sir and CA Vinod Shahji to please welcome him on behalf of a study circle with a token of appreciation and gratitude. Thank you.
इतना बड़ा मोमेंट तो देख के मेरा दिल ललचा गया। आई एम रिमाइंडेड ऑफ वन डायलॉग फ्रॉम दिल चाहता है, जब वो लोग बोलते कि केक खाने के लिए तो हम कहीं भी जा सकते हैं, इतना बड़ा मोमेंट मिला तो कहीं भी जा सकता हूँ। No, but good morning everyone, and thank you for being here. I think if there is one thing that I like about JB Nagar Study Circle is I like the enthusiasm कि सुबह 9 बजे भी लोग संडे को आ जाते हैं, and which is a big thing, and you reflect really the ICI motto that was played just now, right? Someone who is awake when everybody is asleep. So that is literal, because on Sunday morning everybody, after a long weekend, whatever, we are all sleeping when everybody of you is really awake here. So the topic which you have in hand, I think we will have to really remain awake, because there are some rulings which have come which are a little complex. But what I will try and do, my endeavor will be to try and give you a little bit of the background on the law, so that at the end of the day, when you leave, you will at least know some of the basics, I would say, because I don't really know there may be some who will be experts, bigger experts than me in the audience, but there may be some who may not know so much of international tax. So the idea will be to try and to appeal to everyone to ensure that everyone gets at least some value add from this today's meeting as such. और of course कैलाश जी की जो शायरी थी उसने मुझ पे एडिशनल प्रेशर डाल दिया है. So I'm reminded how India was facing pressure in the final of the Asia Cup. So दो बार जीते, then the law of averages is bound to work sometimes, right? So you are under pressure. Champions Trophy 2017 में सब कुछ जीत के फिर फाइनल हार गए. एशिया कप में भी ऐसा होगा, but I mean it ended in a happy ending. Hopefully this also will have a happy ending as such. Right. So what I have done today in the area of international tax, as you can see from the topic, I have tried. Sorry, first of all, let me first do my duty of thanking JB Nagar Study Circle and Kailash ji and Lalit ji for having invited me here. Not that it requires too much of persuasion for me to come to JB Nagar, because I live on the Warsaw metro, so it's 2 hops. Hop and jump is a term that people use in hop, skip and jump that they use. And therefore I just have to hop into the metro at DN Nagar or Warsaw and come here to JB Nagar. And that is one additional reason why I prefer coming to JB Nagar. So, yeah, so with that, let me go into the topic of the international tax. Before I go into the topic, let me just give you a quick overview of non-resident taxation, right? So as you know, the scope of total income under the Act, what does it say? that, okay, scope is different for a resident, it is different for a non-resident. For a resident, your global income, your total worldwide income is included. So if a resident goes anywhere around the world, if you win, if you organize a show, for example, Arijit Singh goes and performs in California, Los Angeles, wherever the show, that amount is taxable in India because he is a resident Indian, and therefore his global income would be taxable in India. As that's the result. That is the reason why sometimes if people start having higher overseas earnings, they probably these days you've heard a lot of people wanting to migrate abroad and leave India. Probably they feel that they may go to a particular jurisdiction where tax rates are much lower and India doesn't tax them. So they try and ensure number of days outside India so that they don't get taxed in India. So the point is that as a resident, worldwide income taxable. As a non-resident, two types of income, basically only one type of income is excluded, which is income which arises outside India and income which is received outside India. So that is out of the purview of taxation, and that goes by normal general principles. You can't have a Mr. Obama being taxed for something that he has not earned in India at all. And therefore, it's very evident that if a person is a non-resident, and when you mean non-resident, you have to look at the entire scope of non-residents. Don't confuse yourself with a non-resident Indian, which is a creature of FEMA. A person who is a non-resident, and then if he is of Indian origin or his parents, etc., grandparents have been born in India, he becomes a non-resident Indian. But as far as the Income Tax Act is concerned, a non-resident is non-resident, and as we have all learned in our days of final exams, etc., that a non-resident, the status is dependent on the physical presence in India, the physical presence, which is important. How many days you are in India, how many days you are outside India, that is really important. For non-residents, what is therefore taxable is income which is arising in India, income which is received in India. Now, what do you mean by arising in India? Let's say Coldplay, a concert, and some famous singers come to India, start performing at wherever, Navi Mumbai, DY Patil, or say in BKC, wherever they are. They have performed services in India, and therefore that income is clearly considered as income accruing in India. Then it is a separate thing that a tax treaty may have a different treatment for taxation of entertainers and athletes as they normally have. But otherwise, that income would be taxable in India because there is clearly a service which is performed in India. So that is non-resident. Non-resident is also taxable on any income which is received in India. And this is important because one particular case deals with that concept of income which is received in India. That means even if services are rendered outside or whatever it is, if money hits your bank account of a non-resident, then he will be taxable in relation to the income, even though those incomes were received outside India. And this is a problem which has faced a lot of people who are on ships, merchant navy and other people who may be employed with an Indian shipping company like a shipping corporation or whatever else that you may have. A Scindia ships which used to be there. There are many cases in relation to people who were on the Scindia steamships at some point of time, or Varun shipping or whatever it is. All those people who are on a merchant vessel outside India, but if the income is hitting their bank account in India, then the question is that taxable in India or not? So that is taxed as per the domestic law, right? So that is the position as far as a non-resident is concerned. One, income accruing in India, income received in India. This is very clear. Then what has the legislature done? The legislature has, in order to widen the net, as you know, Nirmala ma'am और बाकी वो देखते ही रहते कि कैसे ज्यादा टैक्स कहाँ से निकाले etc. So they have to widen the net, and in order to widen the net and to bring in incomes of non-resident which was otherwise not taxable under accruing or received in India, we also have a concept under the Income Tax Act which is called deemed to accrue or arise in India. Now, why was this concept brought in, deemed to accrue or arise in India? Is because there were many incomes which were paid by an Indian resident to a non-resident, but that non-resident would not claim the deduction because he would render services from overseas. He would give you a floppy disk in relation to technology from outside India and send it here. And he would claim that, look, these services are, this income is not accrued in India, nor is this income received in India because he has sent the money to my bank account outside India, therefore not taxable in India. So if you remember in the 70s, India was a big importer of technology. That time Indian industry had not grown up so much. So har ek cheez ke liye we used to have a German collaboration, a collaboration with the US, UK, etc., many such companies. And whenever you wanted to make payments to these people, India would not get tax on the entire amount, though the non-resident would earn that amount, because they would ensure that the incomes were rendered either outside India or delivered outside India, income received also outside India. So India said we are losing a lot of money, and they brought in 1976 something which is called the source rule. That means income ka source kidhar hai? The source is the person, the Indian payer or the Indian company which is making this payment. And therefore they said that you may be a non-resident, you may not have rendered services in India, but because an Indian payer has paid these amounts, and if these are of these two categories, if they are of the category of technical services or royalties, then we will tax them in India, irrespective of whether you come to India or not. US में बैठे हैं, US में services render किया, package दिया, कुछ भी किया, no, doesn't matter. We will tax you at source. So that was called a source rule. And I remember that in those days, Mr. Palkiwala in his book had written that just imagine what a source rule is. That if you go to probably a barber in a shop in London, and he is one of the types like a Javed Ali, and these days barbers call themselves stylists, right? They don't say कि हम लोग से बाल काटते हैं, they are stylists. And इतना पैसा charge करते you really feel it is a stylist. तो पूरा पैसा चला जाता है तुम्हारा wallet by the different type of things that they offer as such. So he said that if you want to pay a barber in a shop in London for a styling, and if it falls in the definition of a fee for technical services, you will have to deduct tax at source from the barber in London. So that is the implication of the law. Why? Because he rendered a service, service was utilized by a resident of India, and that service could be classified as a fee for technical service, because fee for technical service is a very, very wide meaning. Right? So that is where the law was. And we all criticize the law by saying that India is this extraterritorial, has India extended its tax net beyond the boundaries, because that's not allowed. Countries are not allowed to extend the tax net beyond what it can reasonably. But it passed muster before the Supreme Court and others because they said that there was a nexus. There was a nexus because an Indian person was making that payment of that amount concerned. Many years down the line, nearly 50 years down the line, India has been proved right, because if you see all the literature which has now come into the International Tax Forum, one particular paper called the BEPS, Base Erosion and Profit Shifting as it's called, there also they say that the country where the source arises will have a right to tax that income. So there is a complete shift in taxation from to source, from at some point of time only received, only where the place it is incurred, to where the source is. And why did they bring in? Because they realized that large non-residents like Amazon, like Starbucks, etc., were all based in havens, tax havens, etc., and were not really paying tax. So today, for example, before a WhatsApp or whatever came into a picture, he may be earning, maybe the largest number of subscribers may be from India, but he may not be paying any tax because it doesn't have a permanent establishment or any other connection in India. And therefore, it is important that the people who are making the payment to the revenues should also get a fair share of the amount which is being paid to the recipient. So as a result of which, coming back to the story, I'm going to only give you stories, as I said. to story that is why they extended the term of an income for a non-resident to also income which is deemed to accrue or arise in India. First, as I said, it was accruing in India, received in India. To that they added a term called deemed to accrue and arise in India. Now, what does deeming mean? As you all know in law, deeming means something which is not really so, but it is deemed to be so. So, for example, somebody says that, okay, you walk like in a particular way, you are deemed to be a transgender. This is how we form our impressions in our mind. So, for the purpose of income tax, there can be deeming fictions. For example, transfer, as we know, transfer includes sale, exchange, etc., also includes so and so, so and so. The legislature has a power. That power, of course, can be questioned in a court of law. Do you have the power or not? But if there is an excess and if there is a power, then legislature can tax that. So, income deemed to accrue or arise in India. And for today's discussion, why am I taking it up? Because there are three types of payments which get definitely attracted. One is fee for technical services, as I explained the logic, royalty, and interest. Even in case of interest, when you make a payment to a non-resident, wherever the loans may have been contracted, etc., the moment a resident pays it, that amount is deemed to accrue or arise in India. So section 915, 916, 917 was brought in 1976. And that is an important aspect that you people need to remember, because when you issue that form 15CB, if there is a payment which is made and it attracts the provisions of 915, 916, 917, then there could be an exposure to the non-resident to tax in India, the deemed to accrue or arise in India. Now, this deemed to accrue or arise in India is a thing which India keeps expanding from time to time because they want to ensure that non-residents pay their due share of income. But so this was the domestic law. Now, I suppose that you are fairly clear now about the domestic law accruing, receiving, deemed to accrue or arise as such in India. Now, when India and when the globe started dealing with each other, they brought in this concept called tax treaties. And what is a tax treaty? A tax treaty is an agreement between two countries. Tax treaty means what? Agreement between two countries. Treaties are not new to India. Way back in the 1600s, when the British first came to India and wanted permission to trade, they may have entered into an agreement with then Mughal kingdom with Emperor Jahangir and said, हम लोग सूरत में ये trading करेंगे, वो करेंगे, हम लोग यहाँ से पैसे लेके जाएंगे, and this is the agreement which we will enter into for the purpose of trade. You must have said, you bring A, B, C, D to India, I will give you so and so, so and so. So there was an agreement based on which the entire trade, etc., took place. So that is what is called a treaty or an agreement. Closer home, you may have a treaty for a water dispute, for a water sharing. You always know that between Tamil Nadu, Karnataka, there's always been a dispute in relation to sharing of the river, waters of the river Krishna. It flows from both the states. कैसे बांटेंगे पानी, कितना hydroelectric dam ना लगाएंगे, क्या करेंगे? So there is a treaty, and the treaty has been validated, say, by the Supreme Court. So that treaty provides Karnataka can do this, Tamil Nadu can do this, any other state also it flows through, they also can do something. So that is what is called a treaty or an agreement. So similarly, when international trade was happening, then it was very important for countries to know what the liability is. And if you are dealing with countries like India at that point of time, which used to have 90% tax and whatnot, then people would be scared to come to India and say and deal with them because they would not know what the law will be at any point of time. They will feel, okay, suddenly they may tax me this income which is not taxable. I'm supplying goods from outside India. Normally this is not taxable because sale has happened outside India. But suppose they go and impose a tax, no, we will tax that, then what happens? And therefore, through the medium of tax treaties, what countries did with each other is they said, we will agree to a certain set of taxing rules which are contained in the treaty, and the treaty's provisions will prevail as opposed to the domestic law. What that did is that it helped the non-resident that wherever he was dealing, and it can also apply to India. An Indian person, if he goes to Canada or he goes to Japan, those days, as I said, we were importer. Today, we are net exporters of technology everywhere. Our people are there everywhere. which you saw from the H-1B visa and everywhere in the US, that we are at a target because we are now intellectual capital as such. So what happens is when you are dealing with them and they bring in a funny rule, I can always go back to the treaty that I have entered with the country and say that as per the treaty, this is not taxable. So a treaty is often described as a mini legislation by itself. A tax treaty is a mini legislation by itself. So it's like a parallel income tax. Only thing is that the treaty is very easy. Treaty is written in very simple language. It has got very clear things that this will be the treatment if there is a payment in the nature of technical services. This will be the treatment if the payment is in the nature of royalty. This will be the treatment if the payment is in the nature of capital gains. And the treaty is like a draft model, is based on a draft model which is common. So if you see all the treaties, most of the treaties will concern identical language, more or less, with some variations here and there. But what that does is, for a non-resident, he doesn't have to too much bother about the income tax law because he knows his treaty between India and that country well, and he can rely on the treaty for the purposes of the income tax paying in India. So these are the two aspects that you need to understand properly before we take up the case laws: the Income Tax Act, the treaty. Now, as per Section 90, subsection 2, the Income Tax Act provides that you will get to avail the benefits of the domestic law or the treaty, whichever is more beneficial to you. That means you can toggle, just like you toggle between two people, youngsters toggle between different girlfriends like that. You can toggle between the Income Tax Act and the treaty. So if you want to choose the Income Tax Act, you can choose the Income Tax Act that's more favorable. If you want to choose the treaty, you can choose the tax treaty, whichever is more beneficial to you. And how does it apply? I see the Income Tax Act, as I said, there was a draconian provision under the Indian Income Tax Act where resident Indians may complain, but we can't do anything. But a non-resident can say, no, I don't want to go by the domestic law. I want to go by the provisions of your tax treaty and be governed by the tax treaty. So that way, the provisions of the tax treaty override the provisions of the domestic law as far as that particular aspect is concerned. And therefore, tax treaties are extremely important because every tax treaty that you have is negotiated after months and years of discussion with each other. India will see, for example, Singapore knows that a lot of Indian people, a lot of my people use Singapore in order to do oil drilling from India. Or as we will see in one case, Ireland is very famous for leasing of aircraft. Most of the aircraft is leased from Ireland because that's a jurisdiction which is famous for leasing of aircraft. Then they will probably use, and in the treaty will be standard, but they will put one or two clauses which are specially there in order to try and tap that kind of income which arises in both these countries as such. So that is a tax treaty. The benefit of a tax treaty is that sometimes the domestic law may tax you, but you can always go back to the tax treaty and claim that I want to take the benefit of the treaty and therefore there may not be a tax. Why is this important? Again, because when your client is making remittances to non-residents and everything else, if suppose he is able to get the benefit of a treaty and he says that the amount is not taxable, then you will be very happy because in most cases what happens is when you are dealing with non-residents want to make the payment net of taxes. He says, I don't trust your jurisdiction in India, what they will tax me. They will tax me 50%, 60%. I am not sure. Assessee the tax officer will harass me, etc. So I want my 100 rupees, whatever is the tax, you have to bear. And therefore, those payments are called agreements which are net of taxes. That means tax has to be borne by the Indian resident. And therefore, it becomes an additional cost for the Indian resident. 100 rupees that you're paying, plus if there's a 20% tax rate, then your cost becomes that much so much. So if you look at what is a tax treaty and what is a domestic law and what is the correct position, you may be in a position to help your clients in getting a lot of relief as such. So this is a little bit of background that I thought that I will give you before I go into the topics of tax treaties. Now, the way I have arranged this is there are some decisions which are relating to permanent establishment, non-resident, some on some type of services, which is under 917, some on 916, one in relation to salaries, etc. So that you get a little bit of an overview in respect of all recent decisions on international taxation. Right, so I will cover 7 case laws today. Hyatt International, starting from 2 decisions of the Supreme Court, and the decision of the Hyatt, which is a recent decision of the Supreme Court, is important. Yesterday, the Niti Aayog has released a paper. The paper is in relation to permanent establishments and how those profits should be taxed. So that is how proactive now the government is. They are saying, why don't we make it easier for non-residents to conduct business in India and assure them of a flat rate of tax or whatever it is, so that if that happens, then we will get a higher amount of income which is being taxed in India. There will be certainty, there will be no litigation. Terence, idhar aa jaye. So Hyatt, then there's another decision of shelf drilling. Though the decision of shelf drilling is not a concluded ruling, it is a ruling where there was a split verdict. However, it is very important because there is a lot riding in relation to this particular ruling. Nearly 1 lakh crores is the amount of revenue involved as far as the government is concerned. And therefore, we will hear from it. But it is good to know what the observations are, so that you can use it for if you have any client of that particular sort. And then other decisions, as I said, we will come to from time to time. So let's start with the decision of Hyatt. Now, Hyatt, as you all know, is an international hotel chain. Now, how do hotel chains normally work? In India, if you were to go to the FIBB at that time when all these chains were established, they will normally allow you to pay a certain amount of royalty for the use of a trademark and a certain amount of whatever payments which was there, that was earlier quite fixed. Then, of course, now as the rupee has become convertible on the current account, they're allowing you different type of payments as the model may be. Hyatt is obviously a US entity. The parent is a US entity. But in this particular case, as you will see, that this particular entity, the South Asia entity, which was receiving the money, was based in the UAE, the United Arab Emirates. Maybe they were catering to, say, Southeast Asia or whatever it is as such, right? So that is what is the Hyatt case. Now, in the case of Hyatt, as we normally see, what happens is, suppose Kohinoor tomorrow wants to become into a Holiday Inn tomorrow. Holiday Inn, what will it have to do? It will have to give a certain percentage of its room revenues or whatever as maybe royalty or whatever to Holiday Inn. Holiday Inn will ensure that you have to maintain certain standards of Holiday Inn, because wherever a client goes, wherever a customer goes, he has to say have the same look and feel. You go to a Subway, any place, anywhere in India, anywhere in the world, you see the same thing. McDonald's, you'll see the same thing, right? These are like franchises. So a Kohinoor International will be owned by an Indian owner, whoever that person is, Mr. Indian Desi, and he will be making a payment to a non-resident to Holiday Inn for the trademark. There may be also payments for technical know-how from time to time. There will be payments for marketing and sales, because in order to promote this entity or to promote the Holiday Inn chain group everywhere, you will have certain income, advertisement income, which is incurred by this particular client everywhere, wherever it is. So that is the amount which is being paid by Indian hotels to the non-resident. Now, why Hyatt probably registered itself in the UAE is because between the treaty between India and UAE, there is 2 benefits that happen which are not otherwise available to non-resident. That is, one, there is no clause for fee for technical services. So if a man makes a payment for which will be classified as fee for technical services, a UAE resident can argue that this is not taxable in India, because there is no clause for fee for technical services at all. It is business income. I don't have a permanent establishment in India, and therefore I'm not taxable at all. So that takes me to what is a permanent establishment. I explained to you about the treaty. Treaty is like a mini legislation. Now, under the treaty, one of the main bases of taxing is whether the foreign company has a permanent establishment in India or not. So imagine that what is the definition of a permanent establishment? It is defined in the treaty, but normally what the common sense logic is that there should be some amount of permanence in relation to the activity of the non-resident. That means if he has an office in India, if he has a workshop in India, if he has a permanent place in India, if he is doing something which is in India for a permanent time, then that non-resident is supposed to have a permanent establishment in India. And because if he has a permanent establishment in India, then India can tax him. On the other hand, if he is only doing some stray activities and not having any presence in India through a permanent establishment, then that cannot be taxed. The permanent establishment is sought to be extended by countries to also include that if you have people who are visiting from that country to India and they are there for 180 days, 50 days, 30 days, 10, 1 day, then it will create a PE. And why do they do that? They do that so that people cannot just avoid taxation by having people on the ground and still not paying tax in India. So that is what is called different types of PE. There could be a service PE, there could be a fixed PE, there could be an agency PE, and so on and so forth. So these are.
There is a difference between permanent establishment, the registered place of business, and where the entity registered for the
So see, if there is a foreign company and it wants to do business in India legally, right? Then he will have to come via the whatever is the RBI. Earlier RBI used to take approval. Now there is all under the automatic route. So he'll come to the RBI, he'll file FCGPR and he'll invest in an Indian company and he will do business. But that the Indian business will be doing business and they will pay obviously whatever tax that ABC in India also will be paying. So that is a subsidiary. Over and above the subsidiary, let's take this as a foreign company who is doing business in India. What is the permanence of that entity? How much is it? Is it only a sporadic activity, one-time activity, or is he doing regular activity? And that will determine whether he has a permanent establishment in India or not. Clear? So as I said, permanent establishment earlier was defined to mean fixed place, office, workshop, etc., etc. To that, they also added that if you have a foreign company and if you have people on the ground for a significant number of days, that will create a PE for you. If you have an agent in India who procures all goods, everything for you, etc., for your sale, and he virtually acts and signs on your behalf, then he is a dependent agent that can also create a agency PE as such. So these are various PE definitions, which is a little more complex. I won't go into all that. Suffice to say that they chose UAE because UAE had a higher threshold as far as people were concerned. That means even for 9 months you were there, it did not trigger off a PE, and therefore they thought UAE is ideal. If the technical services per tax nahi bharna padega. Dusra, even if I have people for say 9 months and all, it will not create a permanent establishment. They therefore chose UAE as a particular destination as such. Now, what they did was Asian Hotels would be an Indian companies. Last I remember, it used to be owned by the Sarafs, the Saraf group, which used to own the Hyatt in India, that is Asian Hotels and things like that. So they may own the Grand Hyatt, they may own the Hyatt Regency. There could be different owners. They will pay this technical services as well as royalty, etc., to the non-resident, which is Hyatt. So they entered into something which is called a strategic oversight services agreement. With the strategic oversight agreement, normally some hotel chains, they prefer, once they give you the trademark, once they give you a little bit of overall guidance supervisory, they ensure that your hotel branding, etc., is exactly like what they want of the foreign chain, then they don't bother too much. But here under the strategic overseas agreement, what Hyatt was seeking to do is to provide strategic planning, know-how, and we will see that the activity was considerably higher than a mere recipient of income by providing trademark royalty or ensuring a common set of standards as such. So they argued that look, income is not taxable. There is no fee for technical services. This SOSA agreement, the strategic oversight services, where I am providing know-how, etc. services, leads to fee for technical services. But under the India UAE treaty, there is no technical services clause. This is business income. I don't have a permanent establishment in India, not taxable at all. That was the contention of Hyatt. However, the tax department did not agree. They said no. First of all, your services agreement is something where you are providing a huge amount of supervision. You people are interfering in every activity of the hotel and influencing the decisions of the hotel. So you're not playing a massive passive role. You're playing a very core and active role in relation to the running of the hotel in India. Therefore, you have a permanent establishment. Two, they said if not a permanent establishment, part of this is nothing but your know-how over a period of time, and therefore it should be considered as a royalty. Income tax department, आप सब जानते हो, एक नहीं तो दूसरा तुक्का, दूसरा तीसरा तुक्का. They always put 2-3 things. They put नहीं तो एक तो कहीं ना कहीं register हो जाएगा, पकड़ जाएगा उसमें. So that is why they put it like that. When the matter went to the when the matter then went to the Delhi High Court, and when the matter went to the Delhi High Court, the Delhi High Court considered the matter and they saw something that, of course, the facts are not very clear, but it seems that there was a trademark agreement also. And it is not clear whether the trademark, there was royalty paid and tax which is deducted. Otherwise, what happens is that whenever you go before a judge, especially at the High Court, Supreme Court, वो लोग देखते हैं अरे इतना सारा income etc. but कुछ भी tax नहीं pay किया इसने इंडिया में. FTS को बोलता है नहीं है, UAE का clause पे deny करता है, ऐसा करता है. So they get a little bit of prejudice against the taxpayer, even if they are correct in law. So it is not very clear. There is a mention of a trademark agreement, but the Delhi High Court doesn't record it. The Delhi High Court records an argument of the tax department and the taxpayer कि वो बोलता है कि ये पूरा SOSA agreement है, उसमें से part of it you can attribute to royalty, and which they said no. But when it came to the aspect of a permanent establishment, they looked at all the activities in detail. They said you have a right to appoint the general manager, you have a right to appoint people in India in relation to the hotel, you have a right to take all strategic decisions, you have a right to do all that. You have people who are flying in India, out of India. You have carefully structured. Say, suppose the treaty says that you have to be here in India for 9 months in order to trigger a P. You have ensured that you have people less than that period. However, your overall conduct is such that it clearly talks of a pure, I would say, a complete control, strategic control over the operations of the hotel in India. And therefore, to that extent, you are having a permanent establishment in India. It was argued by the assessee that I don't have operation. I'm only giving him technical know-how. Everything is managed by the Indian company and the hotel. I give him some strategic insights in relation to the main man, the general managers who is there, because I want this to succeed as well. Because if you succeed, I will get higher income under the SOSA agreement. However, otherwise you don't play an active role at all. And my people come from time to time. They don't have any dedicated space which is available to them in that particular place in Delhi. And therefore, I don't have a permanent establishment. Because in the permanent establishment, one important aspect which has to be seen is that do you have a particular fixed place at your disposal? If you have a fixed place at your disposal which is available to you, then there clearly can be said to be a permanent establishment because you have a dedicated space which is available to you, though you are a non-resident. Though you are not registered in India, by taking RBI approval or whatever it is available. And in the Delhi High Court, the judge actually compared this to a chartered accountant who goes to a client for audit. And he says, when you go to the client for an audit, very often the client gives you a particular room or a cabin to sit in. But there is no permanence attached to that room or cabin. And once you finish your audit, you are out of it. On the other hand, take for example, if an auditor is given a dedicated cabin throughout and he has a right, this is only auditor can enter, nobody else can enter, then there is a certain degree of permanence or control that he has over that space. So the SSC had argued that look, ऐसा कुछ नहीं है, I only get whatever space, I am not entitled to space, though actually you have been entitled to space, but he must have said कि मेरे को कोई ऐसा space नहीं है, जब मैं आता हूँ तो कभी बोलते हैं कॉन्फ्रेंस रूम ए में जाओ, कॉन्फ्रेंस रूम बी में जाओ, कॉन्फ्रेंस रूम सी में जाओ. So I don't have any degree of permanence or control over the space, therefore I have not a permanent establishment. In the course of the ruling, the revenue then invoked a decision which had come earlier, which is called the decision of Formula 1 in relation to permanent establishments. And what was the decision? This is, you know, near Delhi, there is a Gautam Buddha Nagar which was built, a track, a circuit track, where we said, okay, we'll bring Formula 1 races into India. And when they built that dedicated track in India, that time there was a championship that was held and Formula 1 came into India. There was a dedicated circuit track and that championship was going to be there only for 3-4 days. But this was going to be continuous for 5-6 years. That contract was entered into maybe by the JP Group with Formula 1 as such. Now the revenue argued that to the extent that you have a track and you have complete ownership over the track as well as every decision that you take in relation to the track is your decision, you are having a permanent establishment because you have a fixed place at your disposal. And it is not only once that 2 or 3 days, it is once every 5 years. For 5 years, every time a championship will be held, you will have the complete say over how this particular championship is arranged. And therefore, it is a permanent establishment. So they sought to invoke that look at in substance, though this person may not have a permanent space, however, this is a permanent space, he may come regularly. And you are just trying to avoid by saying that he doesn't have a permanent space, he sits in conference A, room B, C, D. He has higher power than even my employee to sit anywhere. And to that extent, he has a higher degree of control as such. So as you see here, that what did the revenue argue? Revenue said that it is a high level, it is much more than high level formulation. You are getting into everyday activity of the company, of that Asian Hotels company. And to that extent, there is a certain amount of permanence which is there as such. They relied on the decision of Formula 1 to say that just like in that case, you had 4-5 days spread over 5 years where you had this control over the track and all the activities around the track. Similarly, here you are having entire control over the Indian company, though the owner is an Indian and he has employed his people as such, but you have a business, you have a permanent establishment, and because of that permanent establishment, whatever you earn should be taxed as business income. So what did the Supreme Court finally say? Supreme Court said, observed all this. And as I said, bad facts sometimes made for bad case law. Always, if you will see, if your facts are bad, then sometimes the case law also that will develop will be bad. Because the facts are like that. So here he had, as you can see here, he had the right to appoint and supervise the general manager. He had the right to implement HR policies. He had control over pricing, branding, marketing, managing operational bank accounts, and assigning personnel without owner's consent. So they saw all those factors in the agreement and they said, this is not merely high-level control. This is a huge amount of operational control that you also have over this particular entity. And therefore, we don't agree with this argument of yours that this is only sporadic activity, high-level activity, and you are only providing intellectual technical services. There is a greater degree of permanence which is so extended. And these are core functions. These are core functions that you're performing because they are in relation to the running of the hotel. Your business also is running of the hotel. That business also is running of the hotel. They are core functions, and therefore, because these are core functions and you are exercising so much of control and power of the Indian entity, you are considered to be having a permanent establishment in India. So finally, based on all these facts, the Supreme Court held that they had a permanent establishment in India. Now, what happens if you have a permanent establishment in India? Once you have a permanent establishment in India, the simple thing is, just like our foreign company is taxable, you will be taxable on this SOSA agreement which was there. Suppose he received, say, 20 lakh of rupees as per the SOSA agreement. That 20 lakhs will be taxable at whatever is the rate of tax which is available to a foreign income. Foreign income rates also have been brought down in the last 2-3 years because as compared to Indian income, earlier there used to be a huge gap. Now foreign tax income is also there. So it's not always bad to have a permanent establishment in India because the foreign income will be, foreign company will be taxed with whatever is the PE amount, but it will be taxed at the rate, but you will get taxed on the net income, just like any Indian resident. You don't get tax on the gross income, you get tax on the net income. So sometimes it may be better for you to be taxed at net income. Say suppose your income is 100 that you have received and there is expenditure of 80. And what is your profit? Your profit is only 20. So even if you have a higher tax rate, say of 35% or 40%, which applies to you, it will be only 20% of 40 or 40% of 20. On the other hand, when you are taxed as fees for technical services or royalty, you today have a domestic law tax rate of 20%. So that 20% will be much higher than if you are having a permanent establishment in India. So sometimes don't go by impression. Sometimes a permanent establishment will be better. And therefore, I'm reminded of one joke which I just read yesterday, where sometimes things may look worse, but they're not as worse. And this is a quote by a famous tennis maverick player who used to play in the times of Bjorn Borg, called Ili Nastase. And he said that I didn't report my stolen credit card to the police station. He said, I didn't report my stolen credit card to the police station because he said that whoever is stolen it is probably spending less than what my wife would. So he said, stolen, card is stolen, but no problem. He said, I'm in a better position. So similarly, you may be having a permanent establishment, but you may be in a better position because you will be taxed only on the net income as such. The last point in relation to the Hyatt International, which is also an important factor, is that, okay, once you have a permanent establishment, what will be the profits that you will be taxed? Normally, it is the profits which is attributable only to the PE. So suppose Hyatt is an entity in the UAE, as we said, and they may be earning incomes from India, Sri Lanka, Pakistan, Bangladesh, wherever they have a Hyatt property, all may be going to the UAE. You can't tax them on that entire income in India. It can be only income which is attributable to the permanent establishment in India, which here is the SOSA agreement, other agreements. And therefore, that has been something which has always been controversial, how to attribute the income to India. Kitna percentage India mein lene ka, kitna percentage outside lene ka, that is the problem. And that is exactly what the Niti Aayog paper is suggesting. That let us use a presumptive rate of tax, just like you have presumptive taxes today for oil and gas companies, for aircraft, etc., etc. Similarly, we will have a presumptive rate of tax is what the Niti Aayog paper says. And based on that, only that much which is attributable will be taxed at a particular flat rate. Today, it is not there. And therefore, the danger is that if you have a permanent establishment in India, then a tax officer can say, oh, sara ka sara tax mein karta hu, they all related to India, and I will tax your entire 50% of the profits which is only related to India, and I will tax that amount. So that attribution is not clear. That is why people are worried of creating a permanent establishment in India. So that's the important point. In the context of the permanent and the attribution of profits, in the Hyatt case, what happened was that they said that Hyatt globally has made huge losses. And therefore, if you know, in the Income Tax Act, there is a rule which is called Rule 10, which is apportions the profit when you have to determine how is the amount which is attributable in India. Now, this Rule 10 is a very old rule, must be from the 61, etc. This rule must be here. And that is a rule which is likely to be revised, as I said, after this Niti Aayog paper, etc. So they argued that since globally Hyatt has made losses, even in relation to the whatever is a permanent establishment, we are so seeking it to tax, it can only be a loss, it cannot be a profit. The Supreme Court negated that argument. They said, no, this is an independent entity by itself. And just because they are making losses elsewhere doesn't mean that they are not making profits in India, and we will not agree to that approach. It will have to be independently worked out how much is the profit that is relatable to the India unit, because you may have a global income of a client. For example, say suppose in India you have a construction contractor and in India he is making losses, but he may make huge losses because in India you know how it is. Recently in Chennai, one foreign company withdrew because he says, "Itna regular targets dena padta hai mujhe, that I am not able to survive in India." So like that, construction contractors or somebody may say that, no, I don't want to stay in India. I am making huge losses because there are hundreds of agencies to be paid. But at the same time, he may be making huge profits if he executes in UAE, Singapore, etc., wherever. So one cannot say that Singapore cannot tax him because overall his global consolidated balance sheet is a profit and loss account is a loss. So like that, Supreme Court said that Hyatt operation in India, just because there are global losses, you cannot say that the Indian operations are loss. Attribution exercise will have to be worked out, and we will see that what is the taxable income. Finally, the important takeaways of the Supreme Court is the disposal test is very important. Is the place at your disposal, not in form, because in form here in the Hyatt case, there was nothing which is available to disposal. I gave you the example of a chartered accountant, etc., right? It may not be, but suppose if there is something at disposal, then you can very clearly say, okay, there is something at your disposal. But many of our audit teams sometimes joke that we always have a permanent room in a client's cabin. Sometimes could be A, B. That means in substance, you have a permanent place of business there, and then
We have made a 20-year agreement. कि हर साल हम लोग ही करेंगे. The SOSA agreement was for 20 years. We didn't take 20-year agreement. So, wrong comparison.
No. I'm saying that in the Delhi High Court, the judge compared it by saying the permanent. He only was trying to say that is it permanent or not permanent. That's all.
The judge was misguided. Actually, the chartered accountant, he doesn't know.
No. He gave just an example to demonstrate what would be at your disposal. Do you have that particular cabin at your disposal? Normally, in many places, if you have an auditor's cabin, they will not try and touch that cabin. क्योंकि auditor का cabin है, दूसरा उसको enter नहीं कर सकता है. But say suppose it's not like that. You say every time you come in, you are entitled to a different cabin. जहाँ space है. I remember when I was doing my articles in bank audit, and I used to go to syndicate bank. हम लोग auditor के लिए कोई खुर्ची ही नहीं मिलता था. और फिर जो खुर्ची मिला, जिस दिन वो आदमी एब्सेंट होगा बोलेगा वो जाके खुर्ची पे बैठ कर. So that was the attitude, because they were all unionized employees, so they at least cared and bothered about the auditor. But in bigger firms, at least you have a dedicated space. So it all depends what is there at your disposal as such. So exclusive possession is not essential. They are saying exclusive possession is not essential. What is will be looked at is the substance. And of course, the substance, they found that there was a degree of permanence, a degree which was available at disposal. So this is an important case which you have to keep in mind, the Hyatt International, because it's the latest of the PE ruling, and this is something that you need to look at. The second ruling, the shelf drilling ruling, I will just skip through it very quickly, is because there's only one point, important point to remember, is that, as I said, that this is today a split verdict. One judge of the Supreme Court, that is Justice B.V. Nagaratna, who's not likely, scheduled to become our first woman Chief Justice of India, has passed the decision in favor of the taxpayer. The other gentleman called Justice Sharma has passed the decision against the taxpayer. So it's a split verdict, and it has been put up to the Chief Justice for constituting a larger bench, because if two people have not agreed, obviously they will have to constitute a larger bench in order to hear the issue. Why is it important? As I mentioned earlier, is there is 1 lakh crore plus revenues which are at stake in this particular, because of this particular issue. So now what is this issue? Now, as you know, that in recent times, when it comes to two kinds of eligible SSCs, one, where there has been a transfer pricing adjustment or where there is a non-resident, then they are entitled to a special kind of a facility, which is called the Dispute Resolution Panel, the DRP. So what happens in their case is that the assessing officer first prepares a draft assessment order. Once the draft assessment order is prepared, then unlike our case where they pass the order under 143.3 and then we have a right to go in appeal, in the case of a non-resident, they said that this transfer pricing disputes take a very, very long time. So what we will do is we will give a facility of something which is called a DRP. So if you don't agree with the draft assessment order, there are two options available with you. One, that you agree with the order of the AO and you accept as it is, or you communicate to him that no, I'm not accepting, I want to go before the DRP. Now, what is the DRP? The DRP is a committee of 3 CIT appeals, a panel of 3 CIT appeals who will decide your issue. And when the law was first conceived, the DRP was supposed to be independent, so the CIT appeal, the whole hope was that they will give some decisions in favor of the taxpayer by considering the law. As we see it in experience, everything that the assessing officer does they confirm, except for rectification matters. Rectification के अलावा सब कुछ they confirm as such. So DRP has not been very successful in that sense from a taxpayer's point of view. So once that draft assessment is passed, you go to the DRP. DRP has 9 months in order to dispose of that particular appeal or the petition of the assessee, and within 9 months they have to communicate. The good point is, and why it is still very successful, the DRP route is that against the order of the DRP, read with that of the assessing officer, you can go straight to the tribunal. So we know in most cases CIT will never give anything in our favor. But if you are fast tracked to the tribunal, you are very happy because you at least reach the tribunal quickly. So DRP gives within 9 months. Once this order is given within 9 months, the assessing officer has to pass the order on the basis of whatever the DRP has so decided. And within 1 month of receipt of the DRP order, he has to pass that particular order as such. Once he passes that order, then as I said, assessee has a right to go to the ITAT. Now, all this is contained in a section called Section 144C of the Income Tax Act, which provides for a complete regime as far as the DRP is concerned. Now, in this particular case, there are 2 assessment years involved. In 1 year, assessee had gone to the DRP, he was not happy with the order of the DRP, he went to the tribunal on probably a particular jurisdictional issue. The ITAT heard him and sent him back by saying, you can go back to the DRP, DRP will look at these particular things. So he came back to the DRP. Once he came back to the DRP, DRP took its own sweet time in deciding. You remind me, we know how it is. When a matter is set aside, they take their own sweet time and they never decide the matter so quickly. So they took their own sweet time and they passed the order. There's a second year in which it was again a regular assessment again, but the person did not pass an order within the law of limitation. Now, as you know, what is the law of limitation? It's all contained in Section 153. And now, after faceless assessment and the technology the department is using, they have drastically curtailed that particular period of assessment. And in these periods, in the first case, it was 18 months from the date in which the order is received in the Principal Commissioner's office. And from that, you will have to consider and you will have to pass the order on 153. In subsequent years, in the particular year, assessment year 18-19, it was probably 12 months from the end of the assessment year. You have to pass an order under 153. So this is, all of us know, these are laws of limitation. That means ultimately you have to pass an order within that particular period of time. Otherwise, the order becomes time barred as such. In both these cases, the assessing officer did not pass an order within the time that was stipulated under Section 153. First one for the order that was set aside, and second one for the order that was normal but did not pass within the 12 months as was stipulated for that year. Now that has seen quite a lot of changes. Earlier it was 18 months, then 12 months, 9 months, 12 months, etc., etc. That under 153, there is an elaborate section which also takes care of various eventualities, that if something is stopped because of an order of the High Court or whatever it is, then your time period gets extended. If there is a transfer pricing reference, then it gets again extended by 12 months, so on and so forth. So that was all about 153. Now, all these taxpayers, non-resident taxpayers have argued that even if it is a DRP issue under 144C, you have to complete the assessment within 153, because 153 doesn't give you any specific exemption in relation to this. Wherever they wanted, they have very clearly highlighted that for a transfer pricing, matter is referred back 12 months more. If it's such a case, so and so. Under 153, there is no mention of any exemption for a 144C order. And therefore, to that extent, if you have passed the order late, then it is time barred. What the tax revenue and the council in the Supreme Court, etc., argued was that no, if you see 144C, there are 2 or 3 non-withstanding provisions. Now, you know what non-withstanding provisions are. They are considered as, they are called in legal terminology non-obstant clauses. That means notwithstanding anything, whatever is contained, that means forget the rest, only look at this particular clause as such. And they say under 144C, there are some timelines which are mentioned. Those timelines are parallel to 153. Therefore, you don't have to look at section 153 law of limitation at all. You have to only go by 144C. And if 144C says 1 month from the end of the order after receipt from the DRP, then is entitled to pass an order, even if it is say 48 months after the receipt or the last day of the assessment year. It doesn't matter, because 144C is a separate section by itself. So that is what the Supreme Court had to consider. That do you go by 144C as a specific section, or do you look at 153? Because in 153 there is no separate mention of 144C, and the law should prevail. So Justice Sharma went by what was the notwithstanding clause, and he said that this is the scheme of the Act. 144C gives non-residents extra time, so and so and so forth. And therefore, to that extent, he said non-obstant clause will prevail, and therefore I am allowing the appeal of the revenue. When it came to Justice Nagaratna, she saw the scheme of the Act and she said that whilst 144C is there is no reference in 153 to an exclusion of 144C. And in a taxing statute, you have to only look at what is mentioned. It is a literal interpretation of the law that has to be read into. Only when the law is a little vague, or you can't, it permits of understanding of 2 views, then you are entitled to look at beneficial interpretation, this interpretation, other interpretation. Otherwise, no, you have to go by whatever. Even if the law permits an unreasonable interpretation, you have to go by the unreasonable interpretation. There is nothing which is intended, nothing. Whatever is mentioned there, you have to go by the law. And she said that those notwithstanding provisions are only relevant in the context of 144C. They don't extend your time period under 153 as such. And she also used another beneficial principle of interpretation, that wherever there are 2 views, the view which is favorable to the taxpayer should prevail. So based on 2 sets of logic, one, that the clear law under 153 doesn't permit any extension of time, and 2, that a view which is beneficial to the assessee has to be taken, she allowed that appeal. So as I said, there is a split verdict. Why I took it up? Because it's very important, lot of revenue at stake. I'm however worried, given the lot of revenue at stake, that the Supreme Court may go in for a kind of a compromise order and say, okay, revenue is allowed to do it. And they did that in one case, as you know, in the reassessment famous case of Ashish Agarwal, when the judge saw that the case of the revenue was weak because the assessment had not been completed, he invoked an article 142 of the Constitution, which is rarely invoked for tax cases. Now, under 142, Article 142 of the Constitution is normally resorted to when a judge sees that the law, within the law, he can't do anything, but he has to do justice. Like in the Ram Janmabhoomi case, the Ayodhya case, They said that I could not, there is so much of evidence that there is a temple, there was a mosque, not a temple, no clear. And whatever we deliver will have a issue as such. So there Justice Chandrachud invoked the Article 142 of the Constitution, and he said that look, let the land be here, they should be given some alternative land, etc. So that is Article 142. It is invoked in rarest of rare cases. Or in the case of the Tamil Nadu governor, you had a governor sitting there in Tamil Nadu whose only job was to block the bills which the assembly passed. For 5 years, bills were referred to him and he sat on it and he did nothing. And the Supreme Court said that you cannot sit in like that because you are thwarting the wishes of the majority of people who have elected these legislators who are trying to pass a bill. Just imagine a Draupadi Murmu president, every bill which is sent by the government, she sits on it and says, I'm not going to pass this bill. I'm referring it back. There will be a constitutional breakdown. So in that case, Justice Padiwala of the Supreme Court said, no, you have to pass bills within a particular time. They looked at whatever is the internal working of the government and they said that within 60 days or within 90, whatever the time was, you have to, the governor and the president has to take action on those bills. They have to do that. And that is why suddenly government, everybody started saying this is a judicial overreach, judicial overreach. But isn't it the judiciary's job to prevent a constitutional breakdown? Just imagine a governor. Today, this party may be in power. Tomorrow, the other party may be in power. But the governor is only a constitutional functionary. The main power is the legislature and the assembly, as we all understand. And they are the people who have been elected by the people. They have to. So their 142 again was used because they knew that today there is no power under the law in the Constitution. They used Article 142 to say this is how the governor will go about with power. There is a presidential reference which is going on because the government did not like the ruling and they again referred this matter to the president for a specific verdict in relation to what are the powers of a president. But here, coming back to shelf drilling, point is split verdict, whether law of limitation to be strictly construed or to take a beneficial interpretation. 144C is a separate scheme as available to non-residents and to people where there are transfer pricing and therefore appeal to be allowed as such. Then we come to the next decision of Fujitsu. Fujitsu obviously is a taxpayer based on Japan and it was providing IT software and other kind of services. So they were providing services, those services were being taxed by at the 10% or whatever the tax treaty between India and Japan was, whatever was the applicable rate, that it was being taxed. Now, these people were experts at providing telecom software. So it appears that they must have provided services to MTNL. And in the course of that particular provision of services, they had also provided probably some offshore supplies. They had supplied goods from outside India to MTNL, and there was some dispute in relation to that particular supply on the value or whatever, it is not so clear. Now, the normal principle is that if a non-resident sells any goods from outside India, then it is not taxable in India because sale is completed outside India, right? That is the position as far as offshore supplies is concerned. So on the offshore supplies on the dispute, there was an arbitration process which was set in. An arbitral award was given where it must have been said that MTNL has to pay X number of whatever is the amount of consideration to Fujitsu. And otherwise it was providing services of, as I said, software services. So it was being taxed. So the income tax department said that this should be taxed also. Arbitral award happened in India. It should be taxed in India because of the fact that this was in relation to your supply of services, etc. Now it is Fujitsu argued that I don't have a permanent establishment in India. I'm being taxed in India on my supply of services which the treaty also provides. But an arbitral award is in relation to the offshore supplies, and that is business income. That is business income. It is not fee for technical services, etc. In absence of a permanent establishment, business income cannot be taxed in India. So just because it is an arbitral award doesn't mean it can be taxed in India. And this was confirmed by the Delhi High Court. Important point to remember is that if there is a foreign company doesn't have a permanent establishment in India, any kind of business income will not be taxable in absence of a permanent establishment in India. And therefore, the arbitral award which made the payment to the Japanese company was not taxed on the basis that there was no permanent establishment in India. We then move on to another important aspect. We have time, right?
Yes.
Was it time?
10 minutes.
Great. Then we go to the next topic, which is called COVID technologies. The judgment, the particular ruling by itself has no great significance, but I thought that this may be an opportunity just to inform you of a particular development which may impact a lot of you. So your assessee was a tax resident of USA and he was engaged in maintaining a database overseas. Now, these are the kind of taxpayers who have a entire kind of data which is maintained, and they allow Indian users to use this data for whatever it is. It could be a Bloomberg, it could be any other engineering research, it could be anything, etc. They have a database as such. I can't remember now another name which is very famous for giving electronic information on the internet in relation to a host. There could be industry cuts, there could be sector cuts in a lot of matters, and people would subscribe and pay a regular subscription in order to access this information over the internet, or it could come through way of discs or whatever it is. Now discs are no longer really relevant, but he could get information over the internet. So this person was a tax resident and he was engaged in maintaining a database overseas. The revenue from customers in India was more of subscription for accessing the database. Now it was very clear that the SSE did not have a permanent establishment in India. It was only entertaining customers who used to subscribe to its database from time to time. And they claim that these receipts were not royalty. Why the question of royalty came across is that if you see under what I told you under section 916 of the Income Tax Act, or under the tax treaty when it comes to royalty, what is royalty income? Any payment made for the use of an intellectual copyright. It could be anything, payment for a trademark, license, etc., or payment for any intellectual software which is copyrighted, etc. All that is part of royalty. And in our day-to-day transactions, we have maximum remittances you may have seen towards royalty. Software, use of software is royalty as per section 916 of the Income Tax Act. So here it was argued that this is not royalty, that I am only making use of the commercial information or whatever that is stored in this person's database, COVID technologies database. But he has not given me a copyright to reproduce this database and to further give it to other people. So in other words, the argument of the taxpayer is that I am making use of a intellectual property product, but my payment doesn't give me a right to reproduce that intellectual property as such. Now let us take an example to understand this better. When you buy a book, say you have a book called you may have heard of this book called Gavar's Company Law, which company law is very famous, or a Butterworth's publication or whatever. You buy that book in India, the copyright may be in relation, maybe with registered with Butterworth's or whatever it is. When I buy the book, I pay for the price of the book as such, and the book has intellectual property right of Butterworth. So what am I facilitated? Why may I purchase that book? I'm only facilitated to use the book, to read the book, or do whatever it is. On my own, I cannot then reproduce the book as a copyright and sell to other people or reproduce it without the permission of Butterworth, who is the owner of the copyright. Right? In any book, you cannot do this. Otherwise, you'll be hauled up for copyright. But my purchase of the book and the payment to Butterworth doesn't mean I'm making a payment for franchise or licensing that copyright. I am only making the use of a product which embodies intellectual property, but I don't have a right in turn to license that or to further reproduce that book without the permission of the owner, and therefore my payment is only payment for a use of a product. It is not a payment for a copyright. Now, what is a copyright? A copyright under the Copyright Act, etc., is a negative right. It is right to the author that I restrain other people from using it without my permission or reproducing it without my permission. So the argument of the taxpayer is when I'm making this payment, if I am reproducing it, then it is royalty. If I'm only using the book for my own purpose, it is not royalty. And it is exactly same when you have an MS Windows or whatever software you may use, an Adobe or whatever, etc. you use. You're only using the Adobe software or using the MS software or any other software. You're not getting a right to reproduce. So when you make a payment for that, then it is not considered as royalty, but it is only mere use. And that is the argument of the taxpayer. Now, this was a matter of great debate earlier, whether it is royalty, and what the department did, income tax department, like section 1916 was amended. As I said, that our claim was that we are only using the product, we are not using the copyright in order to be, for this to be considered as royalty. So they amended 916 with retrospective effect, and they said that even a use of the software, not the right to use, but even a use of the software would lead to royalty under the Income Tax Act, retrospectively amended. So very typical, as you know, earlier we used to have that what is called that bond, where if nothing fails, we go and retrospectively amend the law to say this was always the law as we existed. So in a very detailed decision, but again, the earlier concept that I explained to you came to the help of the taxpayers, which is that the domestic law may say anything, but the tax treaty, whatever is the wording of the tax treaty, and if they are more beneficial, then you should go by the provisions of the tax treaty and not the domestic law. So under the tax treaty, because the tax treaty has to be agreed between different countries, both countries had agreed on the OECD model, and they said that use of software is not royalty. Only the use of the right to reproduce software will be royalty. And therefore, based on the wordings of the various tax treaties, the Supreme Court gave a very detailed judgment some years ago in the case of Engineering and Analysis 2021, where they said all such payments, whether by a distributor to an overall vendor or the use of software, will not be considered as royalty at all. That judgment is a masterpiece judgment by one of the best judges of the Supreme Court who existed, called Justice Rohinton Nariman. If you have a chance ever to hear Justice Nariman, he is a complete intellectual authority on his own. And this particular judgment, he has analyzed various clauses and said that how under the Copyright Act you are not getting any right to reproduce the product, you are getting only a mere right to use the product, and therefore it is not royalty as such. So in this particular case, the assessing officer did not agree with that particular position, and he said this is taxable based on a Karnataka High Court decision which was then reversed by the Supreme Court. And therefore in this court, they had a very easy job. They said now Supreme Court is there. The tax department argued, no, it is pending now before a larger bench of the Supreme Court, or we have filed a review petition. They said whatever it is, the decision of a Supreme Court in engineering analysis is already there. And there is also a 3-member judge bench which confirmed this decision of engineering analysis. And until such time that that decision is there and the earlier order is not reviewed, we are going to accept the decision as it is, and therefore they allowed the appeal of the taxpayer. So as I said, this judgment on its own doesn't really lay down any great proposition, but wanted to invite your attention whenever there is a payment for software, 15 CB, etc., which comes in, no problem at all. Till there is a tax treaty country where you're making the payment, that tax treaty country has a definition of software which is not like the domestic law, which is a narrower definition. You can say the amount is not taxable, no tax requires to be deducted on any payments for software. And this is a very important decision of the Supreme Court called Engineering Analysis Center of Excellence, which is being followed now regularly in all high courts and tribunals. Which subscription?
Database.
Yeah, data also. Data also. Yeah. ODD, there are of course different aspects of royalty which are not covered here. One is the right to use industrial commercial equipment. Then there could also be use of particular other equipment, etc., which also there. In GoDaddy also there was an earlier decision again, but it has been reversed by the Delhi tribunal. I don't want to go into too much detail. I'm restricting it to the important point that should be communicated to everyone is that there is a Supreme Court decision on use of software as well as the database also, that it is not taxable. Then you come to another decision of Sony India Software Center. And again, I used this because it also deals with something that you use, that you experience on a day-to-day basis. I explained to you, as I remember, if you remember section 917 and the source rule, that irrespective of where the services are provided, it is taxable in India if a resident makes a payment on two accounts, fee for technical services and royalty. And I said that that embodies what is called as the source rule. So in this particular case, SSC is an Indian company. They made payments to a tax resident of Singapore. And there are two payments which they are talking of. One is a reimbursement for a secondment of an employee. And the second one is for training services. Now, normally whatever would happen is if a client would come to us and say that I'm making payment for training, and does it fall under taxable 917? Would have to say yes, because fee for technical services is very widely defined. Any managerial technical consultancy services comes within the definition of fee for technical services. And therefore, if you made a payment for training abroad, normally it would come under 917 and you would have to deduct tax at source under 195 of the case, as the case may be. However, in this particular case, they wanted to use the tax treaty between India and Singapore, and the taxpayer argued that yes, this is a service of training, but what am I providing in the training? I may have provided management skills, I may have provided something else to the persons of Sony India Software who have come here to take training from me. But there is a concept in the treaty which is a little fine concept that all types of services are not taxable. Only services which there is a technical transfer of knowledge to the user are taxable on the ground that they have been made available. So let me give you one small illustration. Let us take an Indian chartered accountant who is using a foreign chartered accountant for the purpose of understanding US GAAP. The person comes in, he provides that service. Now, under the Indian Income Tax Act, this is a service of a technical consultancy nature. This would normally be taxable under 917. But with many treaties that India has, and with most of the advanced treaties like US, Singapore, UK, etc., we have agreed to restrict the fee for technical service clause and say that amount will only be taxable if whoever provides the service is in a position to train the person who is using that service such that he also becomes an expert. So in my example, if you pay for the US GAAP service, it will not be taxable. If, however, that person trains you and you also become an expert in US GAAP, there is a transmission of knowledge which happens, then that amount is taxable. In other words, I make a payment, But next time again I have to do US GAAP, I have to go back to him, not taxable. But if that person comes, trains me, that I become an expert on my own, I don't have recourse to him, I don't have to go back to him, then it is considered as taxable in that sense. In this particular case, they said that what is the kind of training that we provided? They said training workshop, performance management, career management, etc. was general training. And we gave our examples. There may have been a motivational speaker who talked about performance management. What are the best features of performance management, career management? The person who comes in must be a normal employee of Sony Software India, would have come, and by that training, he has not become himself an expert, that he can hold workshops and he can deliver them. So in such a case, it will not be considered as fee for technical services and therefore will not be taxable. The real reason I took this, because this is the first High Court decision which has dealt with this concept of fee for technical services by using the make available clause for training services. Earlier, there are many decisions which say that if there is a service which is provided, a service which does not make available, not taxable as such. Just to illustrate the concept of a little further, one of the first cases which came under the make available clause was a case called De Beers, which I had a occasion to advise on. That De Beers, as you know, was a company which was prospecting for diamonds, and they had got the license to prospect over an overall area in Karnataka, in the Kolar fields where there is always some traces of diamonds which have been found. Now, in order to prospect for diamonds over a large area, what do? They hired a aircraft company from Netherlands, not an aircraft company, but a specialized aircraft company with equipment which would go over the area with its equipment and try and identify that probably prospect in this particular area, there is a better chance of finding diamonds. Of course, finally nothing worked. They never found any diamonds, whether here or in Madhya Pradesh, but they incurred a lot of money in equipment. So, but when we made payment to that entity, we argued, I have made payment to this entity which was called Fugro. Fugro had this specialized aircraft. They would fly over the field and then say, okay, try and dig in this particular area. There is a better chance of finding diamonds. And I argued that Fugro has provided a service. It is a specialized service. It's a technical service. Agree. But with that service, does DBA become an expert? No. Because the next time I'll have to again approach him and he will have to provide the service all over again. So therefore, that service is not made available to me. There is no transmission. At the end of the lecture, if I have been able to teach you international tax and you don't have to recourse to me and on your own, that means I have made available the knowledge. So that is the concept. That is the concept, that if that knowledge is made available, if without recourse to me, you are able to solve on your own, it is made available. Otherwise not made. So this is a distinction, and it is much narrower than what is there contained under the Indian Income Tax Act. And on that basis, the High Court, Karnataka High Court, allowed the claim of Sony India Software. As I said, why I considered it? Because if you were to ask me, what about training services under Indian domestic law? I would say it is clearly taxable, because it is a managerial, technical or consultancy services, which is very wide. But under the treaty, and now India has treaties with most countries. There are very few countries with which we don't have treaties. Therefore, you explore the treaty, see in the treaty if it is not taxable. If it is not taxable, then you can take this particular stand. This is a case of an individual expatriate. Now, what happens in the case of an individual expatriate? As I explained, go back to my preliminary things about what is the scope of a income resident, non-resident, right? A non-resident under section 912 of the Income Tax Act is taxable for services which are rendered in India, irrespective of where the contract is entered into or irrespective of where the money is received. So in the initial days, we used to have a lot of people who would say, कि तुमको एडवाइस तो तुम्हारा ठीक है ना, whenever you go to an embassy, तुम हमको ज्यादा टैक्स भरवा रहे हो। वो बोलते कि भाई यू आर अ जापानीज एक्सपैट और यू आर एन एक्सपैट फ्रॉम ताइवान और यू आर अ चाइनीज एक्सपैट, और वो बोलते कि पूरा रेम्यूनरेशन आउटसाइड इंडिया लो, कॉन्ट्रैक्ट भी इधर करो, you may serve as much as you want in India, no tax is payable. Why? Because amount is received outside India, contract is also outside India and therefore not taxable. Then we had to tell them, no, there is a provision under the Income Tax Act called 912, which so provides that the amount is taxable if services are rendered in India on the whole concept of deemed to accrue or arise in India. Go back to my thing. What is deemed to accrue is arise in India? They say once services are rendered in India, then it is deemed to accrue or arise in India. So an expat renders services deemed to accrue or arise in India. If you render services outside India, an Indian resident, technically that also should not be taxable because services are rendered outside. Just the flip side of if a person comes and renders services in India. So this individual was an assignment to a Chinese company. And in the Chinese company, what had happened is that they had rendered services. In this particular case, he was a non-resident also for the purpose of income tax. That he had spent the required number of days outside India in China. And therefore, the question which came up was, the payment was made to his Indian bank account by the Indian company, though he was in China for that period of deputation or overseas assignment. And come back to section 5, what I had said, scope of total income, and then received in India. So the department said, you may have rendered all services in India, outside India, but the moment the money hits your bank account, it is received in India and therefore you are taxable in India. However, the concept of receipt, which I had explained to you earlier, gets overridden by tax treaty, because in tax treaty, that received concept is no longer relevant. Either you have a permanent establishment from which you earn the income, or if you are a salaried income, and if you render services in China, then China will have a right to tax you, not India. And based on the tax treaty, they said that China will have a right to tax him. China must have probably taxed him because he was there for so many days. And therefore, India cannot tax him at all, not taxable as per the treaty. So this is a case of a non-resident, which otherwise also somebody could have argued, I'm a non-resident, which if I'm earning monies outside India, I'm not taxable in India, except as I said, for this one problem that the receipt was in India as such. But take an example, very often this question comes to me from a lot of colleagues like you, who say that, say suppose a person was a resident, he was in India for 280 days, and then he went for an overseas employment. And for that period of overseas employment, he was in the US and has been taxed in the US also. Say suppose they had 90 days, he completed 90 days also, he completed 100 days there, he completed 265 days here. So he is a resident for Indian tax purposes, maybe resident for US tax purposes also. So in a case, what to do? So again, the treaty can come to your rescue, because even if you are a resident in India, as per treaty, if you have rendered employment with a US firm, you will be taxed only in the US and not in India for that particular period of employment as such. Otherwise, if you would have gone by the principles of domestic law, worldwide income for a resident Indian, and as I said, this person has spent 260 days in India and therefore would be a resident Indian, his US income would also have been taxed in India. And this affects where that particular country's rate is much lower than India. Otherwise, you will get tax credit for one of the two. But say suppose if you are in Singapore and you have been taxed only at 15%, or in Hong Kong, India taxes you at 30%, then there is a leakage of 15%. But here, if a person goes to US, Singapore, and that employment is exercised there and that country deducts tax, then you can very well say that amount India doesn't have a right to tax the income as per the tax treaty is the concept of this particular case as such. So another important thing to remember where you have clients who have gone out for the purpose of salary or employment, and this is an important case, and that is the reason I have highlighted this. I think we come to the last decision. This decision is a little complex, and has very lot of complex issues, but I will try my best to try and explain what the issue is. The facts are not complex. It is the argument which has been put forward which is a little complex. Now, as I said, there is a tax treaty, right? As I told you, India has tax treaty with so many countries, more than 140 countries. We have tax treaties with this number keeps growing. Now, what is a tax treaty? I told you also earlier, the tax treaty is an agreement between two parties. And I gave you examples of the Krishna Water Treaty or a treaty that probably Jahangir entered into with the British in those days. That is an agreement. So two parties or two countries enter into a tax treaty with each other and agree on a broad set of parameters. This is how we will be taxed. Now, why treaty negotiation is difficult is that you have to go back to the treaty if you want to make any change in the treaty. It is not like the Indian Income Tax Act कि चलो उठ गया retrospective 62 से करो 76 से करो जो मनाया कर दिया ऐसा नहीं. You will have to go back to, and that is why even though India realized that Mauritius was a tax haven for so many years, we were not able to easily amend the India-Mauritius tax treaty till 2017. Though we knew that people were using the Mauritius tax treaty to avoid capital gains tax in India, because we didn't have a right unless Mauritius also agreed. So we had to pursue it. Because why would Mauritius agree? Their entire offshore business was based on business from India. उसके अलावा कोई business था ही नहीं उनके पास मेन. सब इंडिया का business Mauritius से आ रहा था. So they would not agree कि हमको तो treaty amend नहीं करना है. Capital gains है. It was entered during 83, Indira Gandhi's time, when there was no foreign investment in India. Mauritius was an upcoming destination. They wanted to, and the Prime Minister of Mauritius was a person of Indian origin. अगर आप देखो Mauritius में सब बिहारी लोग ही मिलेंगे, बिहारी भाषा बात होती है उधर. So in that fitness of things, they said कि Mauritius से कौन कभी आएगा, इसीलिए they gave a capital gains exemption there in that particular treaty. That was exploited after 91 when India opened up for foreign investment, and only in 2017 we were able to block the India-Mauritius treaty and the capital gains exemption clause. So the point is, it is very difficult to agree to a negotiation. So under this theory of BEPS, base erosion and profit shifting project by the global, what they said that this is a problem which arises in every country, and they are exploiting a tax treaty loopholes in many countries. So like in this case, we exploited the Mauritius tax loophole for a long period of time. So what they said we should do is that let us conceptualize an instrument called the MLI, the multilateral instrument. By one stroke, what we will do is we will say that these clauses will be amended, and a general ratification will take place between India and the member country, and it will amend all those respective clauses of those various countries. यानी हर एक के पास इंडिविजुअल जाने की जरूरत नहीं है. I don't have to go to US, India, Mauritius, etc. because it will take a lot of time. And why will that country easily agree? Because all other people believe that India is bully as far as taxation is concerned. So this MLI was also introduced that with one stroke you can amend so many treaties as such. So that MLI was entered into between India and Ireland by way of a notification. Now, the Supreme Court, in a ruling called Nestle ruling, had to deal with another aspect of the treaty. So sorry, today there's an overdose of treaties. I know that, but because it's a recent decision, I have to kind of mention that. Now, under India and many treaties that we have with India, normally there is a protocol which is nothing but a supplement of the treaty. That is referred to as a protocol. And in the protocol, what normally India says, right, is that if India ever agrees with any other member of the OECD or whoever it is, that we will have a lower rate, then that lower rate will apply to this country also. How does that work? Let us suppose I have a treaty with Singapore and I say my taxation or technical services is 15%. I will not tax on any interest given by a banking company. I agree with the treaty, right? Now Singapore says this is fine. But in the future, if you were to also enter into a treaty with say Mauritius, because Mauritius is Indian origin, or Fiji Islands, or say UK, because now India, the more Indians are there in UK than probably UK themselves. So give us the same concession. उसको अगर 10% रेट दिया फ्यूचर में तो हमको भी 10% देना, उनको 5% दिया तो हमको भी 5% देना. That is normally contained in a protocol, which both countries agree with each other. Yes, if I agree to a discounted rate there, I will also give you. Just like in the case I talked about Mauritius being the capital gains exemption, when we entered into a free trade agreement with Singapore, Singapore said, give me also the same benefit that you have given Mauritius. I will give you, allow your ICICI bank to be set up in Singapore. I will allow you all these things. But on my part, on your part, you have to give me capital gains exemption. You have already done it for Mauritius. So that we separately negotiated and we gave them. But this may not be possible always. So therefore, the OECD countries make it so that they can get the future benefit that India may have entered in. Now, in this treaty, the Supreme Court was concerned with the interpretation. And in the interpretation, the question was that if India enters into a treaty and subsequently there is another treaty which I agreed for a lower rate, just as I explained, Singapore I gave 10%, I entered into another treaty, say for 5% rate, then does that automatically 5% applies to Singapore also as per the protocol, or is there to be a specific notification which has to be issued by the government? And the Supreme Court said no, it doesn't automatically apply. The treaty, that 5% rate which I'm talking of, will not automatically apply. You will have to be specifically notified, and unless it is notified, you will not get the benefit of the rate. That was the Supreme Court decision in the case of Nestle. And while doing that, they looked at international treaty law, and they said the treaty has to be incorporated into municipal law or domestic law, is what is concerned. This is a decision of the Supreme Court in Nestle, right? So taxpayers felt cheated there. Look, we thought that this is automatic because all throughout it was always believed that it is automatic. इधर 10% है, कोई नए country के साथ तुमने 5% agree किया. Why would you not enter into a lower rate for those people when you already agreed? That why will the government have to notify? And as we know, government is not active enough to keep on notifying. So in this case of sky high leasing, what happened was, just 5 minutes, I'll wrap up. So what happened was that in the case of sky high leasing, this was a lessor of an aircraft which was based in Ireland. As I told you earlier, Ireland has a special treaty concession when it comes to lease of aircraft. Now, normally when you lease aircraft, that is considered as use of commercial equipment and it gives rise to royalty. However, under the India-Ireland treaty, and similarly Ireland would have this concession in many treaties, many countries, the lease of an aircraft is not considered as royalty at all. And therefore, any payment for lease of aircraft would be business income. That entity will not have a permanent establishment in India, and therefore, there will be no tax as such. So whenever an Indigo Jet Airways you see in the airport, you must have seen so many of those aircraft which was lying, either Go Airlines ka, Jet Airways ka jo pada hua tha, they would have been negotiated with some leasing company like that. In Ireland, would have given it on lease to Jet Airways, Indigo, this and so and so. And once you make the payment of the lease, the aircraft is handed over to the respective airline. It then colors it, brands it, etc., flies it, and then returns it at the end of that particular period. So they argued that we don't have a permanent establishment in India, and therefore it is not taxable in India. We have no tax to pay in India based on the India-Ireland tax treaty. Now, as per the MLI that we entered into with Ireland, we agreed to one particular clause, which is the principal purposes test, which means we agreed with all these countries कि हम लोग treaty का tax avoidance या tax benefit नहीं allow करेंगे. If it is for tax avoidance purposes, this is basically what was Mauritius route earlier, as I explained, where a person came only from Mauritius. Most of the US clients you spoke to said कि Mauritius है किधर हमको मालूम भी नहीं है, but they would come via Mauritius. So like that, the tax department argued कि आयरलैंड से ये लोग आए हैं only because they know that the India tax treaty is there which exempts this amount, and therefore they are misusing the treaty provision. And the parent of this company, the ultimate parent, is a Cayman Island company. They have come in via Ireland only with a view to benefit from the India-Ireland tax treaty, and therefore it is like a tax avoidance, and therefore because of the MLI that we have entered into, they cannot get the benefit of the treaty as such. That was the argument of the tax department. To which the taxpayer brought an interesting argument. He said कि आपने Nestle में तो आपने argue किया था कि if the treaty, the lower rate has to apply, each country has to notify each other. यहाँ आयरलैंड में आपने कहाँ notify किया है? I have never entered into a separate notification with Ireland. He has not notified me, and therefore you cannot apply the principal purposes test as far as Ireland was concerned. So basically, they used very intelligently the logic of the Supreme Court decision of Nestle, where they said कि नहीं हर एक में individually आपको notify करना पड़ेगा, by saying कि इधर आपने individually notify नहीं किया है, इसीलिए even if there is a tax avoidance test, that tax avoidance test cannot apply in the context of India-Ireland treaty. You have to separately, country will have to issue a notification. Now, of course, country will issue a notification now, but what that puts the government to is that for each country, they will have to make an issue or notification in order to say that this notification will apply. And therefore, one doesn't know how much this decision will last. But it is a very interesting use of an application of a negative ruling in a positive slant where the matter concerned to SSC. Of course, the facts also help. As I mentioned earlier, bad facts made for bad case law. Here the facts were all good. The facts were that they said, not only am I leasing aircraft to India, I am also leasing aircraft to China, etc., etc. So it's not only one small activity in India. I am a lessor and I lease many aircraft to many other destinations, and therefore this is not only for the purpose of tax avoidance. Two, they said there is a track record that we have for so many years. I am not doing it only as a one-off transaction. So all those good facts also help the SSC to argue that my lease income will not be taxable in India at all. And on the argument that there's a permanent stamp, they say, what permanent stamp? I have handed over that aircraft, Indigo Airlines has taken it from me. It is applying it into India. It is using it for international routes also. Now Indigo flies international. It is completely at disposition. I have no disposal. I have no control over the aircraft. I have nothing at all. And where is the question of a permanent establishment? So on those facts, tribunal agreed with it and said that there is no question of that also. So good facts were that. Maybe even without the MLI, they would have succeeded because the principal purpose test was not of tax avoidance, is what the taxpayer proved. But in addition to that, why this is important is for the point that if you want to also apply the MLI, then there has to be a separate notification which the government of India will have to issue in each treaty case. Not otherwise it will not apply. So very intelligent use. Delhi Tribunal also last week has confirmed the view of the Bombay Tribunal. So this is an interesting development as such. Now, I can go on and on, but as you know, the next speaker is a friend of mine. We used to play a lot of cricket together. And I know he can play the bat very well. I don't want him to hit me with a bat. And I'm conscious of the time as well. So with that, thank you so much for the patient hearing. I don't know if there are time for questions, otherwise I'm happy to take it in the break also. But thank you once again for this opportunity.
Thank you, sir. Friends, really, Hegde sir has given us very important inputs in relation to international taxation, and very, very thanks to him because he has come in a very short period. When I asked him, sir, 2-3 दिन ही बचे हैं, how आपको आना है, तो they cried, how we do. But looking to the session, I can say frequently कि सर आपको 2-3 दिन की जरूरत नहीं है। एनी टाइम जो है जेबी नगर विल कैन रिक्वेस्ट यू टू गिव ए लेक्चर ऑन इंटरनेशनल टैक्सेशन, और ये तो 2 घंटा है। आई थिंक जो मैं अभी देख रहा था, अगर सर ये पूरा पूरा 4 घंटे का भी हो तो सर आपके लिए टाइम की कोई जरूरत ही नहीं है। नाउ आई रिक्वेस्ट आवर डिप्टी कन्वीनर ललित बंसल to please give a formal vote of thanks to our speaker.
Okay.
Thank you, Commander, sir. Thank you, Mr. Hegde, for launching session on practical aspects of internal taxation and recent important judgments shared with us. So the importance of your lecture was, I can say, is that and on behalf of Jaipur Simple Study Center, I propose a hearty vote of thanks to our learned speaker, and also would like to thank all the members and admin staff for their efforts for this session. We have